This is Daniel Dusina, Chief Investment Officer here at Blue Chip Partners, and welcome to another edition of the Blue Chip Partners Quarterly Edge, in which I discuss my outlook for the upcoming quarter with regards to equity and fixed income markets. Just as we did last quarter, we're going to have a little bit of a Q&A style discussion. So I'm joined by Dan Cedar, Managing Partner here at Blue Chip Partners, and he's going to ask me a few questions.
Thanks for having me, Daniel. So there's been a lot of activity in the markets over the last 2 quarters, stocks and bonds. But let's go back to November of 2023. Starting in early November of 2023, stocks went on this massive rally that went through the end of the year and into the first quarter. So thoughts on the equity markets, given this big run up, is it imminent that stocks are going to sell off? Should investors be waiting for a sell off in stocks?
Well, I think the short answer is no. Just because there has been a significant run-up over the last 5 months, I don't think that necessitates a drawdown. And history's on my side on that one. So I would say my argument that I guess I'm still optimistic on the equity market domestically are predicated on 2 different things. The first is just thinking about history. I have some historical data to back this up. And then second, it's just that corporate fundamentals are healthy, and we've seen a lot more widespread participation in equity markets to start this year. So when I think about periods like we've just seen, call it 5 straight months of upward performance from the S&P, 5 months in which the S&P returned greater than 25%, believe it or not, this is not something that has never happened before. And I was a bit surprised when I dug into the data to see the results being that when you have 5 straight months of positive performance from the S&P, the forward returns are actually better than any other 12-month forward period. And the consistency of those returns is generally a little bit better, just as measured by however many times the S&P has been positive after 5 straight months of positive performance. So what you're seeing in this chart that I have on the screen right now, looking at the blue bars, that's showing you the average forward return for the S&P 500 after we've had 5 straight months of positive performance. The brown bars are just showing you the forward 12-month returns for the S&P at any given point in time going back to 1970. So what you'll see is on average, the returns are better, but also these little circles with numbers inside of them are showing you that the hit rate's better. So 93% of the time after 5 straight positive months, the S&P 500 has been positive, which compares to just 80% of the time for any other 12-month period in the S&P 500.
So we've had a big run up in stocks, and the data suggests that run will continue over the following 12 months. Is that referred to as momentum?
Yeah, I think you could think of it as momentum. Realistically, I'm not going to be surprised if we see some choppiness intermittently. And this has nothing to do with the data, but just realistically speaking, the fact that we have seen 5 straight months of just straight upward performance, it's not like we've never seen that before, but it's not like it continues in succession forever for those entire 12 months to follow. So it wouldn't surprise me if it's a choppier ride than we've seen the last 5 months, but the data tells you that historically speaking, we've seen positive momentum continue. I mean, you can look at it a different way too. I pulled some data just looking at any 5-month period in which the S&P 500 has been up north of 25% over that 5-month span. And again, the data kind of lines up to tell you that 93% of the time after that 25% performance in 5 months, 93% of the time, the next 12 months have been positive as well. So call it momentum, call it whatever you want. Data would support that just because we've seen positive and strong positive performance lately, it doesn't necessitate a downturn.
Got it. So for investors, 12 months can feel like a long time. So even though the data suggests that markets are statistically higher 12 months later after a 5-month run up, it could mean in the next month or 3 months or a short period of time, when you talk about volatility and choppiness, markets could pull back. They don't just move in one direction straight up. So they could pull back, but over an extended period of time, like 12 months, the data suggests the market data suggests that the stock market's going higher.
That's absolutely correct. And what I would say gives me more confidence than I had maybe this time last year is that underlying corporate fundamentals look good. So we're seeing strong revenue and earnings growth across sectors, not just concentrated in one or two sectors. But we're also seeing widespread participation in equity markets across sectors that are lifting broad market indices upwards, which we didn't necessarily see at this point last year. And so when I think about the first quarter of last year, in which the S&P 500 was up about 7.5%, versus this year, in which the S&P 500 was up modestly north of that, the biggest difference is that I would assert we're in a much healthier market right now. What am I meaning when I actually say that? Well, if you look at the first quarter of 2023, returns broken out by sector, which is exactly what I'm showing on the screen right now, it was really just 3 sectors and 7 stocks, for those who are familiar with the Magnificent Seven, that drove returns. The majority of other sectors were flat or even negative. If you compare that to this year, we have 10 out of 11 GIC sectors positive. There's a lot more widespread participation and what is contributing to the underlying index return. And I think that that is what I would describe as a much healthier market. So even though that you might see some semblance of volatility over the coming months and intermittently, the fact that we have healthy corporate fundamentals and much more widespread contribution across the equity market gives me a lot of confidence.
Yeah, and I would say for investors, it should enforce or reinforce patience. I really think it's important for investors to be patient during these periods of time.
Couldn't have said it better myself.
Yeah. So let's shift over to fixed income. Fixed income has had a rocky start to the year. So first quarter was a bit rocky for bonds. Should investors be worried about bonds and the interest rate environment today?
I don't think so, partially because I'm in the camp that investors are getting a once-in-a-decade opportunity to invest in the bond market right now. So where's my data to support this? I have some data, but really I just want to focus on 2 points. The first being that the yield you start with in the bond market has historically driven the bulk of returns, and starting yields are higher right now than they were the last decade. So that gives me some confidence. And then second, you have a Federal Reserve that is more likely than not going to be initiating more supportive monetary policy, aka interest rates will be likely trending downwards before they trend upwards over the next 12 to 18 months. So those 2 points are what I want to focus on, and they give me a lot of confidence that you're getting a very good opportunity in the bond market right now. Just looking at that very first point, why does starting yield matter? We can just use a very simple exercise and look at a 10-year treasury bond that's yielding 4%. Let's say you buy that bond at par, $100, and it's yielding you 4% per annum. You wait throughout the 10 years, you don't do anything with it. Prices don't fluctuate because you're not selling it. And 10 years later, you sell the bond, or it matures rather. What was your return?
4%.
It's 4%, right?
Yeah.
You collected the income. And so you can kind of apply that same exercise and methodology to a portfolio of bonds or even a bond mutual fund. The yield you start with is going to drive the bulk of your return over the duration of that instrument. And so the fact that we have starting yields much higher today, roughly 4.5% to start the year of 2024, relative to 10 years ago, say, the last decade, in which you had really had to reach for yield, and starting yields, as I'm showing it on this chart in blue, were 2.5%. You have an ability to just achieve a greater level of return given that yields are lifted much higher. So I think your starting point obviously gives you a better return proposition, but also at the same time, higher levels of income distribution can help better offset any price fluctuation that happens in the bond market.
Yeah, and you know what I think is really fascinating? As interest rates have moved higher, yields have moved higher, bonds have been hit. It's been a rocky ride. But for investors, most investors that are either nearing or in retirement have some allocation of bonds, and their income from the portfolio has gone up. And so as an investor, what you should be really considering is, if I'm not liquidating my entire portfolio in the next 12 to 18 months, and I'm holding, and I have a long-term approach to portfolio management, the higher yields translate into higher income from the bond component of the portfolio. And I think that's that's helping out investors that are drawing that income as they enter into retirement.
That's absolutely right. And, we've been blessed as investors, or honestly, anyone that's participating in the market, to be able to achieve a reasonably attractive rate of return on just cash, incredibly low risk instruments. I think the second piece of my argument with regards to why this is a once in a decade opportunity to allocate to the bond market, I talked a little bit about the Federal Reserve and the fact that when they're anticipating, or when it's expected that they will have a policy that includes interest rate decreases, that's a very supportive environment for bonds, historically speaking. Very much less so for cash instruments like money market funds. So what I see in the market right now, the chart on the screen is showing you, on average since 1980, the direction of yields as measured by the Bloomberg US Aggregate Bond Index, the most common widespread domestic bond index. It's showing you what the yield on that index has done since the Federal Reserve stopped hiking rates. In this case, that was in July. It could be a different month, at different periods through history. But my observation is from this is that we're at the very high end of the range in terms of interest rate changes since that date. Rates really have not come down, and as of this recording, they've actually gone up, which is very, very different than history. And I think that I'm not going to sit here and say that I think history is going to rhyme exactly like it did, on average through history in the past. But I think the fact that you haven't seen any yield compression yet, you still have an opportunity to allocate and get those higher starting yields before your yield starts to deteriorate, especially in some of those cash instruments. So what I'm anticipating is we start to see the current rate environment trend towards where we've seen it historically. And what that also can kind of translate to is much better cumulative return for bond instruments right after the Fed has stopped hiking and ultimately eventually cuts rates. That's a very good environment for bonds. Bond yields and prices move in opposite directions. They're inversely correlated. And so the fact that we have been lagging the historical range of outcomes when you look at the bond market after the Fed stops hiking, to me, there's a lot of catch-up potential. That's what really leads me to believe that this is a once-in-a-decade opportunity. And the last thing I will say on this is keep in mind, as this is happening in the traditional bond market, your income from cash instruments is starting to decline, and your return on a relative basis is getting deteriorated.
Got it. That's really fascinating stuff. Daniel, is there anything else that we haven't covered?
Not to my knowledge. I do think I would say very supportive on the equity side of the business right now. And on the fixed income side of the business, that once in a decade opportunity, I think it needs to come from some of the cash instruments that individuals are utilizing right now. Not necessarily from the stock allocations that individuals have, but I do think it's very much time to start weaning off some of those money market fund exposures and take advantage of what can be a very, very strong market going forward for bonds potentially.
Fantastic.
Well, thank you all very much for joining us and tuning in to another edition of the Blue Chip Partners Quarterly Edge. We look forward to catching up with you again next quarter.